Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Stephen English of Stellar Asset Management to talk about their AIM Inheritance Tax Service. Hello, Steve. Tell me about Stellar and talk about your own background.
Stellar was founded, the chief exec and chairman were really at the vanguard of tax planning products at Close Brothers from the very earliest days. So there's a lot of domain expertise in the tax planning and tax specialist space. That appealed to me. This is a new home for me. Formerly, I was 18 years at Blankstone Singleton, but fancied a new challenge and have always admired Stellar from afar. 1 month into it, really excited what I've found there. Some really good people. The infrastructure in particular should allow me now to deliver a really strong service for our clients.
So, you run the Inheritance Tax Service. What's the aim of it?
Probably like most other AIM IHT providers, but we do think we do it differently, and we think you have to, and I think that's increasingly important. What we're trying to do in essence is protect our investors well from inheritance tax after 2 years. That's the kind of bland overview. But within that, not all AIM IHT providers are born equal. And certainly we are concerned that there is something of a bubble valuation developing. If you look at the top 10 AIM stocks now, the average PE you have to pay for them is north of 45 times. So AIM was infamous because it was full of dross for a long time. And if you actually look since 1997, it's delivered you a total return at the index level of 6%, compared to the FTSE 250 of 600%. But amongst that detritus, there's some absolute gems. And what we are singularly focused on is finding tomorrow's winners, not yesterday's winners. And we think a lot of those yesterday's winners are to be found now in that upper echelons of the market cap spectrum. So we can go anywhere. So we do have some £1 billion plus companies, but our core focus is £200 million and below market cap.
So is there any specific types of companies you're looking for?
I like to have a blend, and I think this is probably another point of differentiation amongst peers. Around 2/3 of the portfolio would be growth or structurally growing companies. These are your compounders, so very high rates of return on capital and able to reinvest cash flows at those high rates of return. So think of it as a very high interest bank account. You compound that over time. That's 2/3 of the portfolio. But we don't want to be exclusively in that cohort because then you're going to be too correlated. So we got around 1/3 of the portfolio in more value, cyclical, turnaround or special situation stories. And they each have their own nuances. But the reason why we like that blend is while value has been a drag in terms of a style, it hasn't actually affected our long-term returns, but as a style, generally value hasn't performed, but its day will come again. And actually looking at some lead indicators now, there's very strong mounting evidence of an inventory restock where traditionally cyclicals do very well and value tends to do well coming out of a recession, which we believe we very much are. So we see a kind of once in a generation opportunity to pick up some very high quality industrial companies to supplement and augment that higher quality, longer term structural growth stories. We also look for your classic profitability is key, but beyond that, they have to be cash generative and they have to have a ability to pay a dividend that hopefully can grow 10 or 15% per annum. We can stretch it out, so if they're not paying a dividend today, if we are pretty convinced they're going to be paying one in 12 to 18 months, then we will invest today ahead of those more income-orientated investors because that can help with a little bit more capital upside before they start to enter the shareholder register.
So have you made any new recent investments?
Pick out one very recent one, DX Group. So these are a freight and courier business. They have express and freight as their two divisions. Secure courier, so very high value parcels they do. They do their express side where the solicitors use them for document exchanges. And then they also do 1-man and 2-man deliveries to the home addresses, private addresses. And there's a logistics business within that as well. This is a classic turnaround in the making. Just now reached profitability. It was badly mismanaged. What I like about it is the CEO and chair come with deep relevant expertise from Tufnells, which they managed before the current management team, or the one that was just thrown out, actually really cocked that one up. So now they've took those learnings to DX. They've been there a couple of years, and you can see the fruits of their labour starting to come through. We see them as in a sweet spot now. They lost their passport delivery contract recently, which has created a lot of capacity within their network. And actually, when you likes of DPD, Hermes and DHL are over capacity, they're getting a lot of inbound inquiries because we're all shopping on the internet now, and they're almost able to name the price when it comes to delivery. So they found themselves right in a sweet spot there. Commercially, they're right in business at the right margins. Longer term margins to the market over the next 3 to 5 years, we expect operating margins of 5 to 7% or 6 to 7. I'd be disappointed. I actually think they can get closer to 10%. And if you fast forward 2 years, the valuation is going to be sub 8 times PE. I think it'll be closer to 5 times PE based on today's share price. On current earnings, because they're very depressed, the PE looks very, very high, which is exactly what you want with the cyclical. But there's also a big investment opportunity with CapEx increasing. The return on their CapEx is very, very strong. They do irregular dimension and weight deliveries. So very, very good story from a CapEx point of view, and also efficiency. They're adding more depots to the network, which improves your density and your route density, and it reduces your mileage, and it improves those operating margins again. And the fact that the CEO is an Evertonian is just further grist to the mill. So he's used to dealing with adversity, clearly.
And what about existing companies have you got in your portfolio? Any particular favourites?
One would be Alpha FX. They provide FX hedging to smaller and medium-sized businesses which aren't big enough to have their own treasury department. So if they're selling and importing goods and products, they need properly structured FX hedging, and their culture is really a standout for them. They floated 3 years ago. We actually got involved in them at IPO, around £2. The market cap was 60 odd million. Fast forward today, the share price is now £11, market cap 400, north of 400 million. And that's really what we look for. We saw that there was a very long runway where they had very, very small market share of that market that's dominated by the large banks currently, but their customer service level is so high, and they're winning customers from them. And we actually think there's a burgeoning story within that business, which is their payment solution business. Very, very small revenues from that at the moment. But again, as we look forward 3 and 5 years, we actually see that being a far, far bigger part of the revenue generating pie. And they're now fully funded to double the size of their business to around 80 million of revenue. I actually think that'll be 100 mil revenue in not too distant future. They did have an issue. One of their Norwegian clients couldn't fulfill a margin call, which crystallized a bad debt, but they have a repayment plan, and they haven't missed a repayment since. But they did have to raise £20 million from the market just so it didn't crimp their growth.
And coronavirus, how's that been for the portfolio? Is it presented opportunities?
I haven't noticed, Alex. Yeah, I haven't noticed. It'd be there are winners, there are losers. In terms of a winner, in terms of a very direct winner, we've had Tristel, which makes very high-level disinfectant. NHS is a major customer, a very special chlorine dioxide solution, so it's wrapped up in a lot of intellectual property, which is another characteristic we look for. Their sales, unsurprisingly, have done very, very well, and there's actually new product development is very strong in terms of the wipes that the NHS uses, these disposable wipes that are becoming an ecological issue now. They have a solution for that, so you no longer need to use those plastic-based wipes. So they've done very well, but we have had losers as well, unfortunately. A former favourite of mine, Shoezone, unsurprisingly. It was the only retailer we had in the portfolio because we don't like too many companies B2C. The consumer is a capricious beast at the best of times, and they're kind of whimsical and change their minds, so we prefer B2B, but that one was consumer focused, and with the shutdown they have struggled. I had a disagreement with management. I thought they should have raised cash, even though they had net cash on the balance sheet. I thought they should have solidified it more than they did. So the outlook is just too murky for too long, and capital's always competing, so we've recycled that elsewhere. Is now a good time, would you say, to invest in AIM? I think it is. I think it is very much so. Again, I'd caveat that the AIM market is a very, very fertile stock pickers market. In fact, there's over 90 companies that have gone up over 100% in the last 12 months. The poor FTSE 100 stock picker has only had one company go up 100% in the same time, and that was Ocado. But within that, you get a lot of dispersion. The losers of AIM are a lot worse than the losers of the FTSE 250, but the winners are a lot better than the 250 and the FTSE 100. And from our perspective, because we are very focused on this valuation risk, where the top 10 are trading on north of 45 times PE, we're constantly recycling into these smaller, less covered companies trading on cheaper valuations, and we're getting our portfolio in for well under half of that in terms of the AIM darlings of the market. So as a Blythe statement, I think you've got to be very careful. I think the AIM market actually resembles the S&P 500 more so than ever in terms of its tech and healthcare weighting. It's 4 times higher than the FTSE 250, so it's kind of in a sweet spot at the moment. But for that quality, and they are quality companies, you're paying up. If your average market cap of your AIM IHC provider is 6, 7, 800 million pounds, I would urge them, the customer, the client, to look under the bonnet and really interrogate the valuation that they are trading on. If you look at our track records across the industry, it looks pretty stellar. Sorry, no pun intended. But a lot of these came from 2010 starting positions when the PE, you could cobble together a portfolio for sub 10 times PE. I do question whether you're going to make a positive return if your starting valuation now is closer to 40 times or even 50 times earnings. We do question that. We think the risk to the downside is too high there.
So it makes the AIM ISA investing potentially very risky.
Risky, and it's not the total solution. It never will be. But I think as part of a wider planning solution, there's definitely a place for it. And with ISA specifically, in many ways, the FTSE AIM market is one of the most tax-advantaged markets in the world. And it makes sense for ISA for 2 reasons in particular. Because these companies, where they dominate a niche, really have so much runway, often they'll go up 5, 6, even 10-fold. So you're looking at a very big capital gains. And we have had clients actually complain that we were generating too much capital gains, which is a nice problem to have. Obviously, if that's in the ISA, then that's sheltered. So it is more of a problem for these companies because they do move appreciably when you do pick a winner. And the other nice thing about it is it can almost become a regular pound cost averaging exercise. £20,000 this year, 20 next year. So you're taking out the vagaries of the market, you're dripping it in good times and bad, and again that can help to reduce your overall risk to capital.
What makes you sell a company?
Malfeasance or fraud of any description, I'll get out on the very, very first warning. Often they don't even know how bad it is. There's never one cockroach in the kitchen. Another one is where we're seeing pricing power starting to diminish. You know, Warren Buffett sees pricing power as one of his top parameters when he looks at a company. And really, that shows up in gross margin. If there's an unexplained gross margin deterioration, we do question that. Other aspects, if we think that the founders are not treating us with enough respect, or they do not exhibit enough integrity, or if incentives are not aligned. What we want are intelligent fanatics running our companies with a lot of alignment, who think, to boil it down quite simply, they think in per share terms, not these megalomaniacs who want to get the market cap from 50 mil to 500 mil because they'll get paid a lot bigger salary, but they own 0.01% of the share capital. We're not interested in that whatsoever. Other things, it could be we just do not like an acquisition, either strategically or more often the price that they pay. As these companies get bigger, the multiples that you have to pay for businesses get bigger as well. And there is a point where that starts to corrupt the model, and we're very, very sensitive to that. So we'll move on and recycle again into these smaller companies that are going to start that process all over again.
Steve, for people who are looking to shield their money from inheritance tax, maybe in their ISA or without, why should they give their money to you?
We believe that there is a real opportunity to access some world-leading companies who dominate their niches, but you don't have to be £1 billion market cap. And in fact, whereas AIM was notorious for having very low-quality companies, if you look back 10 years, now almost the opposite's true. It's abundant with very high-quality companies, but no company is so good that you can't overpay for that earning stream that's going to come. And we think if you're paying now 45 times earnings for the top 10 companies, really you've increased your downside risk. If they missed their numbers, then the stock could quite easily half in value. And actually, it wasn't too long ago, it was only in 2018, where we seen a lot of these companies half just because we thought interest rates were going to rise, and they are susceptible to that. So we've got some growth at a more reasonable price. We think that's a key differentiator. The other key differentiator for us is we're going to cap the strategy. I want to maintain my ability to be unconstrained, to access any part of the market cap, whichever offers the best risk reward. So we'll cap the strategy around £200 million. We want to maximise client returns, not funds under management. And I would urge clients, if their manager hasn't capped the strategy, ask them why. If they haven't capped it, then by definition, they're a forced buyer. They have to carry on buying these stocks, even though they, hand on heart, don't believe that they are going to make a terribly good investment. So we think it is incumbent upon any manager on any strategy to have a natural ceiling, and we will very much stick to that. We also think we offer very, very good value. Being a tax specialist, we have very good distribution. We are on a number of platforms, so our reach is a lot higher than most others in the market as well. And there's a real freedom. We're not death by committee. Sometimes you need to make very quick and nimble decision making within AIM, and we have a lean team, but we do believe in doing it correct. And stock picking is personally in my DNA. My former employer was a stockbroker. I started on the dealing desk, and you never lose that sight of scrapping over a quarter of a penny, because you can have the best idea in the world, but if you are fudging up the actual purchasing on the stock market and overpaying for stock, that bleeds performance as well. So we're very, very focused on that as well.
Stephen English, Stellar Asset Management, thank you very much.
Pleasure. Thanks, Alex.